What if I told you that the biggest financial crash of our time wasn't an accident, but something that a few smart investors saw coming, and instead of losing money, they made billions? That's exactly what happened in The Big Short, one of the most important finance movies ever made. It tells the true story of a group of investors who realized that the US housing market was a ticking time bomb. While banks, hedge funds, and the government were blind to the risks, these outsiders saw the truth, and they bet against the system. The result? The 2008 financial crisis, a market crash that wiped out trillions of dollars, ruined millions of lives, and exposed the corruption of Wall Street. But for the few who understood what was happening, it was the biggest opportunity of their lives. So, what can we learn from The Big Short? How did these investors see the collapse coming while everyone else ignored the warning signs? And more importantly, how can you avoid falling into the same traps in business and investing? Today, on Real Hustle Academy, we're breaking down The Big Short and uncovering the biggest business and finance lessons hidden in this shocking true story. Before we get into the lessons, let's quickly break down what happens in The Big Short. The movie follows three separate groups of investors who, despite working independently, all figure out the same shocking truth. The US housing market, which was considered safe and stable, was actually built on high-risk, bad loans that would soon cause a market crash. Here's how it all unfolds. Dr. Michael Burry, a hedge fund manager, is the first to spot the problem. He analyzes thousands of mortgage loan records and realizes that banks were giving out home loans to people who couldn't afford them. These bad loans were bundled into investments called mortgage-backed securities, and everyone thought they were safe. But Burry sees the truth. Within a few years, these loans will start defaulting and the market will collapse. Mark Baum, a skeptical hedge fund manager based on real-life investor Steve Eisman, hears about this theory and digs deeper. He discovers that banks are lying about the quality of these loans and that Wall Street is making billions off of a ticking time bomb. The deeper he looks, the more corruption he finds. Charlie Geller and Jamie Shipley, two young investors, accidentally discover the scam when they read a financial report that no one else bothered to check. With the help of Ben Rickert, played by Brad Pitt, they realize that they can bet against the system and make a fortune when the market collapses. All three groups decide to do something that sounds insane. They start betting that the housing market will crash. They take out something called a credit default swap, which is basically insurance that pays them if mortgage-backed securities fail. For months, they watch as the market keeps rising while everyone calls them crazy. But then, it happens. Mortgage defaults skyrocket, banks start collapsing, and the entire financial system begins to crumble. And the people who saw it coming, they make billions of dollars. The movie ends on a sobering note. The investors who bet against the system made money, but millions of ordinary people lost their homes, jobs, and savings. The big banks? They got bailed out, and history repeated itself. So, what can we learn from The Big Short? How do you spot financial bubbles before they burst? Let's break it down. One of the biggest lessons from The Big Short is this: just because everyone believes something doesn't mean it's true. In the early 2000s, almost everyone believed that the housing market was unshakable. Banks, hedge funds, economists, even the government thought that home prices would always go up. But Michael Burry, Mark Baum, and the others looked deeper. Instead of trusting the experts, they analyzed the data themselves. They didn't just assume the system was safe, they checked, and what they found was shocking. The lesson here? Don't follow the crowd blindly. Just because a business, investment, or trend is popular doesn't mean it's solid. Do your own research and look at the facts, not the hype. Think for yourself. Whether you're investing, starting a business, or making a big decision, don't assume something is good just because everyone says so. The smartest people question everything. Here's a hard truth: markets don't always reflect reality. People invest based on emotion, greed, and fear, and sometimes they ignore red flags because they don't want to believe bad things can happen. That's what happened in The Big Short. The warning signs were there: rising mortgage defaults, banks giving loans to people with no income, but Wall Street kept acting like everything was fine. Michael Burry saw this irrational behavior and took advantage of it. He realized that just because the market was booming didn't mean it was stable. He knew the numbers didn't add up, and when the truth finally hit, he made billions. Markets aren't always logical, but that can be an opportunity. If you learn to spot hype cycles, bubbles, and irrational trends, you can profit by seeing what others ignore. One of the biggest reasons the 2008 crash happened? No one understood the financial products they were selling. Wall Street created complex financial instruments like mortgage-backed securities, credit default swaps, and collateralized debt obligations, CDOs. And the more complicated they made them, the less people asked questions. In the movie, there's a hilarious scene where a character explains what a CDO is using Jenga blocks because the actual explanation is so confusing, no one understands it. And that's the point. Banks used complicated language to hide the fact that their investments were garbage. They made things sound so technical that even professionals didn't question them. If someone is trying to sell you something, but they can't explain it in simple terms, be skeptical. Complexity is often used to hide risk. Most people think investing is about buying low and selling high. But what The Big Short teaches us is that sometimes the biggest money is made by betting against the system. Michael Burry and the others made billions by shorting the housing market. While everyone else was betting on prices going up, they saw the cracks and placed bets on a crash instead. Short selling is risky, but when done right, it can be a powerful way to profit from market bubbles and bad investments. If something seems too good to be true, it probably is. If you spot a flawed system, sometimes the best move isn't to invest, it's to bet against it. So, what are the biggest lessons from The Big Short? It's not just a movie about finance, it's a warning about what happens when people ignore the truth and follow the crowd. Let's recap the key takeaways. Question everything. Just because everyone believes something doesn't mean it's true. Always do your own research and check the facts. Markets are not always rational. People invest based on emotion, greed, and hype. Smart investors take advantage of that by spotting bubbles before they burst. If it's too complicated to explain, be skeptical. Financial jargon is often used to hide risks. If someone can't explain an investment in simple terms, it's probably a bad deal. Betting against the system can be profitable. Michael Burry and the others didn't just invest, they bet against a failing system and made billions. Sometimes, the best strategy is to go against the crowd. At the end of the day, The Big Short teaches us that financial crashes don't just happen. They are created by greed, ignorance, and a refusal to look at the facts. And the people who saw it coming, they didn't follow the hype. They followed the numbers. Now let me ask you, if you were in their position, would you have spotted the crash? Or would you have been one of the people who ignored the warning signs? Let me know in the comments. And if you enjoyed this breakdown, hit that like button and subscribe for more business lessons from movies. We analyze the best money and finance strategies from Hollywood so you can apply them in real life.